Hello all and welcome to this webinar today on Marcellus Global Compounder Strategy. This is an investment offering predominantly for Indian investors for investing in US and other developed market equities. My name is Hardik and today we have Arindam Mandal, head of our global equities strategy, Jabir, who heads the research for global equities piece, and our lead analyst for consumers, Prashant Mittal, with us. As many of you would have known, we have been running this strategy since last 2.5 years. And I'm very happy to share that we currently manage close to 250 crores of assets under management in this strategy via Gift City. More importantly, the team's ability to identify stocks across markets and with an overlay of discipline on valuation, this fund has delivered great returns for our clients, with our fund delivering close to 25% dollar return since inception and a healthy margin of alpha over S&P 500. Further, I would like to add that the strategy is now available in a tax-efficient structure from Gift City and is also open to selected non-individuals who could benefit from investing abroad. For more information on this, I would appreciate if our participants would write to invest@marcellus.in and we would take it forward from there. Now, in the last 3 years, since the time we've been broadly running this strategy, we've got a lot of questions and feedback from our clients with regards to how we are running this strategy. And in today's session, we've requested Arindam, Jabir, and Prashant to answer some of the
Hardik, I think you froze.
I think Hardik is having some technical problems, so I'll pick up the questions. So the two of these we've been getting right since the beginning, which is why invest only in developed markets, because this fund has a DM only mandate. And corollary to that, aren't we missing on emerging market growth opportunities? The more recent question over the last sort of 8-10 months has been, isn't the US market costly? What about investing in cheaper international markets? So I think we should start with the first pair.
Yeah, sorry, I had a little bit of a glitch, but Arindam and Jabir, over to you to answer these questions and more. Thank you.
Sure. Thank you, Jabir. Thank you, Hardik. We'll try our best. Very, very interesting set of questions. While there is no clear-cut answers to them, we try to share our views. So the first two questions are connected. The primary concern here is if we are restraining ourselves to investing only in developed market equities, then are we missing out on the biggest investment opportunities or themes around the rest of the world, or say the emerging part of the world? We can, one way to do it is to break it down to two parts, as Javin mentioned. So do emerging markets generate much higher return compared to other markets? That can be the first part. The second part can be, is investing in companies that are listed in the high growth emerging markets the only way or the best way to get benefits out of the high growth economies? Okay, so let's start. Let me start with the first one. That is do the high growth markets or the emerging markets do they create the most value, or do they create most wealth for the shareholders? This is a simple chart that we often used in our presentations. So here we have done is we have tried to list down the largest equity markets across the globe. So this is a mix of both emerging markets as well as the developed market economies. So for example, you can find here China, Taiwan, Hong Kong, which is kind of a proxy of China, Brazil, South Korea, right? So these are the emerging markets. And if you look at the 10, 20, 30-year return, yes, sporadically they have done well, but there is no real consistency of generating superior return compared to any other market. In fact, the only emerging markets that has done consistently well is Indian stock market. And these returns are all total shareholder return, the TSR 30-year, TSR 20-year, TSR 10-year. That means that the total shareholder return CAGR, including the dividends in dollar terms. And if you look at US, of course, is on the top. In fact, for most of the time frames you look at, be it 10, 20, 30 year, that it has done reasonably well compared to any other market. Now, this is data, but there has been empirical research has been conducted. In fact, this research was done long back, 20-year back. So it is not a recent phenomena. You might think that it's just last 15, 20 years. It is not. So in 2005, Jay Ritter, as the professor of University of Florida, what he did is a very simple exercise: try to find out the geographies with the highest economic growth, and try to find a correlation if those markets are creating more value compared to other markets. In fact, the outcome was that there is practically no correlation, which might sound counterintuitive, but given the number of parameters typically goes in terms of how you create equity return, that is not just limited to the economic growth of the country. It is good to have, but not at all the most important parameter. The clear-cut example is definitely the US. If you look at this slide, over any time frame, you take it last 10, 20, 30 year, you just pick and choose your time frame. The nominal GDP growth of US market has been around 4 to 5%. The US stock market gives you around 10% dollar return. Again, that is any typical rolling 10, 15, 20-year period, you will find that is the long-term rolling average of S&P 500. Again, talking about the same thing, high return, high economic growth really doesn't mean that will translate into higher return for the equity market. Classic example is definitely China, that is often spoken about. Even if you take out the last 4 or 5 years, where China story has been uniquely hard, despite if you just take out those time frame, still the Chinese market lagged the US market in any consistently rolling 5 or 10-year basis. And in fact, if you look at the volatility, the red line is way more volatile than the blue line at any point of time. Right. And if you look at the GDP growth of these countries, Chinese GDP growth has been almost 3x that of the US's GDP growth. Now, I think these are the data points that kind of validates the thesis that again, economic growth doesn't correlate to superior return. So if you're just looking at developed market equities, it is not that you are missing out on a very big opportunity in terms of the market. Of course, there will be some countries doing better than the others at certain point of time. For example, Argentina did really well last year. So those opportunities do emerge, but in a longer period of time, if you're looking at larger investable developing market economies vis-a-vis the developed market economies, the stock market per se, as an investor, you do not have any evidence that you have created enormous amount of value uh, just investing in those stock markets. Of course, there are pockets of opportunities in every market that exists. Now, if you're an Indian investor, I think the story of investing in developed markets becomes even sweeter. The reason being, Indian stock market has one of the lowest correlation with the US stock market. In fact, Indian stock market has much more higher correlation with other emerging markets. They are typically looked as one basket. So if you're an Indian investor and if you are really looking to diversify, if you're thinking about asset allocation, then the diversification point is actually very, very applicable if you're investing in the developed markets, primarily if you're investing in the US markets. So I think I tried to answer the first part of what Jaibir asked to start the discussion, that if we're not looking into or investing in directly into emerging markets, are we missing out on a big opportunity? This is number one. The second leg to the question is that if investing only in emerging market stocks is the only way to get best exposure to the stories that we often hear, be it across the growth in China, be it the growth across different other markets which are growing at, say, high single digit. Is the only way to get really good exposure to those high growth countries is through investing in their local equities or local stocks which might be trading in those markets? The answer is actually an emphatically no. So we thought about spotlighting two of our companies that we have held in different times in our GCB portfolio. One is Hermes, another is Apple. Of course, I mean, both the brands are very well known. So these two, we believe, are classic examples of showing that if you are a good company, right? If you're a good company, then there is actually literally there is no boundary. So with that, I'll probably ask Prashant to start the discussion. But before that, I'll just take you guys through a startling chart. So this is the last like longer term return of Hermes, the top two bars that you see here, Apple and Hermes. These companies have compounded around 22 and 30% CAGR, okay, in last 10, 15 years. That is the CAGR return. And a large part of their story has connected to, has some connection to China, right? Um, Ironically, US Apple is listed in the US, Hermes is listed in France. So you can say that Hermes is a French company, Apple is a US company. They have delivered growth, massive amount of growth operating in China. The interesting point is that take any of those country indexes, be it US, be it China, or be it France, it really didn't matter. These two companies has been able to grow much way beyond those countries' stock market growth. Now, with that, I'll probably go to Prashant. Prashant, can you just give us some background, a brief background about what is Hermes, what do they do?
Sure, and so the origins of Hermes actually began almost 200 years back, where the company was founded in 1837 by a gentleman called Gary Hermes. And in its initial days, it was actually a harness and saddle maker for French. Over the course of last 180 odd years, the company evolved multiple times, and today it is a luxury good designer, producer, and retailer with a range of offerings across whether handbags, ready-to-wear apparel, jewelry, perfumes, watches, and more. It's also the fourth biggest luxury house by revenue amongst listed companies. As of 2024, last year, it had around 15 billion euros of revenues. Now, the interesting point with respect to our discussion is that the revenue for this company has grown close to 14% over the last 10 years, and net income has grown at more than 18%. Now, whilst one might think that it's a company based out of France and it's an old enough company, and it's, secondly, consumption in any country tends to be, highly correlated with the GDP growth in
That
our
is right.
minds,
Yes.
right? I think we have a chart over here which shows how Hermes has actually, dispelled that myth. On a rolling 5-year basis, going back, 20 years, its gross profit growth has far outpaced range GDP. And that is the central point that, we have tried to sort of highlight using Hermes as an example as to how some of the special companies can outpace GDP growth in their home country and take advantage of growth in profit.
So am I reading it right that the red bars are the French nominal GDP growth, which is around 3-4%, and despite them domiciled in France, their gross profit has largely grown at around 12-13%. Is that
Absolutely.
the
Absolutely. That's
okay?
right.
Okay, great. So how did they do it?
Yeah. So if you can just go to the next slide. Let's just take a step back first of all, right? Chinese consumption story is nothing new. People have been aware of it for the last many, many years. This chart, the red line and the blue line, sort of show the multiple expansion in Chinese consumption. The red line is general household consumption. The blue line has grown 25x over the last 30 odd years is the urban consumption. Now, be that as it may, this growth in consumption has not actually transpired into commensurate returns for the companies that cater to this consumption. The gray line that you see is the MSCI China Discretionary Consumption Index. It's essentially aggregate of companies that cater to this Chinese consumption demand, right? As you can see, while the consumption has grown by 20-25x, index, has gone pretty much more.
Interesting.
So the central point of the slide being that growth in spending is not necessarily equal to stock market returns, which we call value capture, and we'll discuss more the next slide.
So okay, so Chinese urban consumption has become 25x, but had you just closed your eyes, bought the theme, and you buy the MSCI China Discretionary Consumption Index, you practically make nothing as an investor, right?
Now, coming to Vinam's question as to how Hermes was actually able. Now, first of all, what does the chart on the right show? The red line is the Chinese urban consumption. So, in the previous slide, the gray line is the MSCI China Discretionary Consumption Index, which is below, the expansion seen in such consumption. The blue line, on the other hand, is how the Hermes income in China, which has been proxied by Asia ex Japan. They don't break out China separately, but a large majority of Asia ex Japan is essentially China. How the income that they earn in China, vis-a-vis the growth in consumption, has been at another level. So this chart is actually indexed at 100 as of 2008. If you can see the Hermes income has grown from about 100 level in 2008 to more than 2500. So 25x over a 15 year, right? While the consumption on an aggregate basis has grown by 5x, while the index, as we discussed in the previous slide, is again too much. How has Hermes been able to do it? Is A, they have not participated in the volume focused approach that a lot of brands in emerging markets tend to focus on. Rather, what Hermes has actually done is focus on the most profitable segment, the topmost sliver of Chinese consumers who value exclusivity, craftsmanship, and quality of products. That's sort of the core of Hermes. They don't go for volumes. In fact, their store count has actually reduced over the last 15 years or so, as compared to many brands who keep increasing their store count. What they focus on is providing products which are timeless in nature to the most choicest of customers, the most upper echelons in any country. And that's exactly what they did in China as well. And by capturing this value, by capturing these customers, they have been able to grow at a far higher pace vis-a-vis both aggregate consumption as well as the general MSCI consumption.
Got it. That's very fascinating. So the best part of Chinese consumption growth or the Chinese prosperity that has been captured by Hermes, right? That's what it is showing, that from 100 to it has went up 25x in last 18 years.
Yeah,
The
last
profit.
15 years, it's gone 25x, and that shows up in its financials as well, right? It's a company that runs 70% sort of a gross margin, right? So it caters to people who are willing to pay that because they're looking for something that no one else offers. They're
Got it.
willing to offer a product which is such high quality and not available very, very easily, right? People will be willing to pay a price that is. That's the way it's been able to capture an outside sort of a portion from the Chinese consumption.
Got it. So basically, when you see the number of billionaires exploding in China, that is what we've seen in last 20 years. I think the number two very closely following US. So that part shows up here, and the growth rate of that number is actually much more than your in general consumption growth.
Growth in billionaires, and what wallet share they can take out of that.
Right, exactly. That is true. Yeah. So you're
Right.
not doing the
So
discounting. Yeah, absolutely.
right,
Yes.
because they do enjoy a very strong local customer base and they keep going again and again. It's not
Right.
like, I've sold them to them once and then I'm done with it. No, they keep coming back. They sort of spend a lot of time on inculcating those relationships. The repeat buying aspect of those topmost sliver of Chinese consumers helps them to capture an outsized portion of their wealth. And that's a big point.
Right. And how does it capture the share price?
Arindam, sorry, just before that, Prashant, could you be closer to the mic or be a little louder?
1 second. Is it better now?
Yeah, please continue.
Right. So, yeah, I mean, what I said just now about the company it reflects quite
Yeah, absolutely.
strongly in
Fascinating.
terms of share price returns. Last 30 years, I mean, you can't even see the MSCI consumption index. It's almost lying on top of the x-axis. But even if if someone was to play a devil's advocate and say, how does it do when when China came out of, sort of a tough phase during mid 2010s, 2015, 2016 phase, after which consumption boomed and even, the Chinese consumption index sort of went up by 2.5x or so. Even during that phase, Hermes was able to beat the index returns by a substantial amount.
Right.
Hermes returns were more than 3.5x compared to 2.5x returns from MSCI consumption index. Now, this is not just something which was related to a frenzy in the stock and people were just bidding up the stock. There was a sound basis to it. And if you go to the next slide, you can actually see it, right? So the chart that we just saw, share price returns, is the top chart. And below it is the kind of earnings growth that was seen in Asia ex Japan over the same period. So as you can see, the earnings grew by 3x as well, right? And this was on the back of expanding margins, which grew from somewhere around 38% or so to more than 45% over this 5 to 6 year period. So this is a very strong point, right? That no matter what economic phase, because you're catering to a set of customers who A are much less affected by the general doldrums in the economy, and B who actually value your offering and hence are willing to pay a high price, which translates into high margins. You would be able to capture an outsized portion of consumption no matter the economy. China ho, India ho, it doesn't really matter.
Right. And I think it is also important to understand, given even in the latest slowdown, last 1 or 2 years, the difference between Hermes and other brands in China that is kind of showing up, right? That
Absolutely. I think the hierarchy has never become more. Hermes has been able to grow at 15% last year. So 24 was, a classic sort of a reckoner for anyone looking at how, luxury brands can be differentiated. So Hermes grew at 15% or so, the sales grew at 15% or so. At the other end, you had something like a Kering, which owns the Gucci brand. It was absolutely decimated. More than 20% decline in sales for the Gucci brand. In the middle, you have something like a LVMH, which was more flattish. Similarly, a Richemont, which was, doing something in mid to high single digits. So the focus on exclusivity, whilst not letting go of their core, highest quality ingredients, they are backward integrated. They just don't buy stuff from, any other channel. They have a very, very strong, either they own it themselves or they have exclusive partnerships. So right at
right,
the ingredient level, they're absolute geeks, the way I call it. They are
right,
just, if you read those annual reports, you just start seeing, oh, there's so much to it than, what people perceive to be. So yeah, to your question, last year was a classic sort of a trailer as to how luxury had.
right. So I think the takeaway here is that not only you get great growth in terms of numbers from China, you get a resilient growth. So your cyclicality is much lower. So in fact, what my takeaway has been, I've been learning a lot from you, is that if you really want to play the Chinese consumption story, which has been strong and which might still be strong because the country has, if you think about the number of people who came out of poverty in China, it is close to around 70 crores, right? Huge number of people who have become more affluent over time. And the prosperity for all probably it continues for many, many years. So the best way to probably play China consumption is probably these European luxury companies. I mean, that's the probably most resilient way to play this incredible growth story that we have seen. Is that a fair
Absolutely.
point?
Even within the
Yeah.
luxury brands, the best of the lot. If you're looking at resilient growth, uh, Hermes is almost incomparable.
Right. Great. I think that's fascinating, Prashant. With that, let me go to the next one. So Hermes was sailing into China, right? So kind of penetrating the most impactful or the most affluent part of the Chinese prosperity. The second leg to the story is probably making in China and also selling a bit there. So Apple, I mean, the logo is familiar to all. Jabir, any introductory comment on Apple?
Apple is the largest cell phone manufacturer in the world, largest by value, the largest watch manufacturer in the world, by value, the largest earphone manufacturer in the world, and by value, the largest laptop manufacturer in the world. But to be fair, most people know them for phones, and their canonical product is the iPhone. Almost every stuff which was launched in the last 20, 22 years. If you sort of go back 23 years to 2002 or so, that was the first year Apple started seriously sourcing from China. Their partnership was with with a business which we all know as Foxconn, but which is part of a listed company called Honhai. So Apple signed up with Foxconn in 2002, and Foxconn was their primary supplier for the next decade or so. And even today, Foxconn remains a significant partner for Apple. If you look at the 10-year period from 2002 to 2012, you'll see revenue for both companies grew broadly in tandem. If someone were to try and look at this chart, they would conclude that, okay, both companies added a lot of value in that period. But that would be misleading. If you go to the next chart, this basically shows the gross profit that both companies earned over that period. Now, Honhai did grow, but nowhere close to the way Apple grew. So from that same 10-year ramp in sales, because remember, this 10-year period included products like the iPhone and the iPad. Through that 10-year ramp in sales, Apple got a lot more of gross profit than Foxconn did. Right? This is classic value capture. Value capture happens with the brand, not with the contract manufacturer, as long as the brand is strong. And here, Apple demonstrated that quite clearly. Now, sorry.
Yeah, so that's classic actually. So the previous chart, after 2012, Apple lagged, Honai or Foxconn lagged, but here the value capture part is quite stark, right? And I'm assuming that shows up in their market caps as well.
Yes. So I think Apple has added roughly $3 trillion of market cap in the last 22, 23 years. Honai has added a small fraction of that. I think they're about $100 billion, but I'm not sure of the number.
So no, that is fascinating. So almost 30 to 40x. And I'm assuming that Foxconn probably employs almost 8 or 9x that of total number of Apple employees, right? It's a classic case of value capture. And how did they do it? I mean, this is so fascinating.
On your employee count number, so the actual number would be even higher, because remember, there are also subcontractors in the chain. So
right.
In terms of total headcount involved in making an iPhone, Apple probably employs less than 10% of them.
Wow.
Everybody else works for either Foxconn or one of the other suppliers.
So with 10% of employees, you are basically created a company which is almost like 30x of
Of
people
your
who actually doing
biggest
work.
supplier. Yeah.
Yeah. Wow. That is amazing. Okay. So how did you do it?
So Apple looked at China quite differently. If you sort of think of when most companies talk about manufacturing in China, especially 20 years back, the way companies talked about manufacturing in China, it was entirely about cost cutting. So if you think about apparel companies at that time, or even electronics companies at that time, the way they used to talk about China was sourcing, was cheap sourcing. Apple looked at it quite differently. Right? They invested quite a lot behind their suppliers. They created capabilities in that supplier base. They created depth in that supplier base. What this enabled was a very resilient and complex supply chain. Now, to put that in perspective, Apple makes more than 200 million iPhones a year. That product, of which more than 200 million need to be made in a year, gets refreshed every year. Right? That means that there is an inventory ramp up and an inventory ramp down, which happens every year around the product launch. And that adds even more complexity to the supply chain. The resilience of that supply chain, we all got to see during COVID. I'm sure people remember how difficult it was to buy a car during COVID, all those chip shortages. You could still walk into a store and buy an iPhone, and an iPhone uses a lot of chips. This entire capability where the product portfolio has grown, where this annual refresh cycle cadence has been maintained, where the quality of the product has been consistently upgraded over time. Right? All of this reflects the supply chain that they were able to build in China. Now that's a true partnership exercise. It's not about cost cutting. It's about building capabilities and benefiting from them. Now, the other side of Apple in China, which frankly seems secondary, is the fact that they also built a reasonable sized business in China. So Apple sales in China went from under $1 billion in 2009 to north of 55 billion by 2015. They managed to do this without having to enter a JV, which is very rare for a Western company. They navigated all the potential political problems that Western companies in China occasionally run into. Now, and as I mentioned earlier, they managed to create the supply chain, which even through all those COVID shutdowns and through all the disruptions that happened in the first trade war and probably in the current trade war, kept going, kept delivering iPhones around the world with a reasonable degree of reliability.
Right. So on that point, Jabir, I think there's a new book that came in, right? So Patrick Maggie, so Apple in China, kind of exploring what they did over time. So there's a fascinating read. I recommend our listeners to go through it. I mean, there's a lot of stories embedded into it, so you'll get probably more color. No, I mean, so very intriguing. So Apple not only cracked the making in China, but they also took benefit of the China prosperity. So the selling point, I mean, so it is fair to say that probably around 700, 800 billion of market cap can be attributed to just China, right?
So the selling in China bit probably smaller, but if you take the making in China bit, then a lot more.
Got it.
Right.
But it is still,
if it's only selling in China, probably less than 500 billion.
Got it. But it's still, I think, is larger than the largest company in India, right? Just the value capture from China, from selling there. Oh, that's great. So I think these are the two classic examples where we look at how to benefit, like how Hermes benefited from selling in China, and Apple benefited from making in China, and to some extent selling in China. So that probably gets us back to the second question that we that you thought about addressing, that do you really invest in the local companies only to get the most out of the market? I think these two are exceptional stories. I think no other company operating in China has been able to, make as much profit as Apple did. So truly exceptional. But as long as we can identify these kind of stories across the globe, I think you just need not, pigeonhole yourself into finding out the best country and trying to find out something that can actually capture that growth. It can be available anywhere. It is not local. The exceptions can be global, and that's exactly what we're trying to do here. So,
So Arindam,
yeah, go ahead, Jeremy.
now these the third question in Hardik's list. How do you think about that? Because that is something. If you sort of look at our 2.5 year journey, index valuations have changed a lot in that time frame. There is, and especially when you compare that to some of the other markets, there is a reasonable gap there. If you compare it to history, there's a reasonable gap there. So how do you think about valuation?
Yeah, that's a great question, and we scratch our head too. Actually, I mean, there is, again, as I said, there is no clear answer, yes or no, when it comes to investing. So broadly, this is what the data shows. If you look at the top, the leftmost bar, so S&P 500 is trading at around 22 times forward earnings. Historically, it has been around 17, somewhere between 17, 17 and a half. That's the 10, 15, 20-year average. Interestingly, the second bar from the left, that is the equal weighted S&P index, that is trading at around 17 and a half, which is in line with its history. So the question typically that we get quite a bit is, Europe is cheaper, then it is probably more attractive compared to US, because US is pricier. Now, there are different ways to look at it. Again, as I said, there is no right or wrong here. And at times, these market valuations get so distorted that you see some convergence. But what we've observed over time is that a lot of that difference that we see in the index level valuation can be attributed to the composition of those indexes. I took a very crude example here to explain this. For example, we took two great Indian companies. Okay, one is HDFC, another is Titan. Great compounders, great long-term history. Now, if you look at last 10 years, HDFC Bank has compounded their earnings or EPS at around 20%. Titan also has compounded their EPS around 20%. Now, suppose you construct an index that has only Titan, right? And you construct another index which is only HDFC Bank, right? So at any point of time, you go in the history, that will find that the index that had only Titan, that is actually trading at almost 10, 15 points higher than the HDFC Bank index, the index that only had HDFC Bank. So HDFC Bank index would probably trade at around 20 times P, whereas the Titan index would always trade at around 30, 40 times P. Now, why so? Because the financial services companies, primarily the banks or insurance, there's a lot of regulatory capital requirement that goes into it. So their growths are typically constrained. These are heavy capital requirement. They're not capital light business, but they're heavy capital intensive business. So they tend to have some cap around the return on capital employed, right? So as a result, in general, you'll find that, as I said, you can see clearly here, HDFC Bank will always trade at a discount to that of a Titan. That doesn't really mean that the index which had only Titan is actually an inferior index. In fact, you can argue that Titan actually probably has done better than HDFC Bank in last 10 years, right? Despite HDFC Bank delivering slightly better EPS. Now, that is how the composition of different markets vary, right? So what we did to simplify it, we took two largest enterprise resource planning companies, ERP software companies across the globe. One is Oracle, listed in the US. One is SAP, listed in Germany. So SAP is the largest European technology company, and Oracle is the largest ERP company. Correct me, Jaybir, if I'm wrong, but ERP, I think it is the largest ERP company. It is not Microsoft does a lot of cloud, etc., other things, but ERP, enterprise resource planning software, Oracle is the largest company in the US. So if you look at their valuation, they are very comparable companies. In fact, Oracle grows slightly better. SAP and Oracle, they are trading at similar multiple. The point we're trying to make here is that if there is a way to normalize this index, those two indexes like MSCI Europe, European index, and S&P 500, then the difference that we see in the index level, that is primarily very similar. So incidentally, we found this report, actually very latest report from Morgan Stanley. They exactly tried to do this, that normalize these indexes based on the industries that they operate at, right? So every industry will have their own range of price to earnings ratio. And if we adjust for those things, interestingly, what we see here, that the MSCI, the leftmost two bars, the MSCI US is probably trading at, if you look at the gray bar, is trading at around 23 times. Adjusting for those changes, the MSCI Europe is trading at probably 20 times, and MSCI Japan is trading at a 21 times. So the point is, optically, it does look like that the US market is trading at a much higher premium compared to the rest of the market, but probably that is not the reality. Like for like comparisons for those, all the markets are kind of in the similar level. So that brings us back to the first slide that we looked here, is that if you look at the long-term history of S&P equal-weighted index, that has been actually same over time. So on a large basket basis, if you took the entire basket, the stocks haven't related that much. It is just that the composition of the indexes have actually changed massively over time. So again, we have just put here some data. So if we just segregate these two, the US market into different distinct groups, one is, say, capital heavy or capital intensive industries vis-a-vis capital light industries. Okay. So the capital light industries typically get a much higher premium in their valuation. Remember the HDFC Bank and the Titan example, right? So they typically get a much higher premium. In 2010, the capital light industries constituted only 30% of the index. Now, if you look at now, that is around more than 50% of the US S&P index, right? So that, to some extent, I'm not saying that the S&P 500 is not pricey or anything like that, but to some extent, it is a shift in business model, especially in the large cap companies in the US that we have seen, that explains that why the valuation gap has rose over time, right? Has risen over time. So again, as I said, there is no clear-cut answer here. We just try to find out that, okay, why is it happening? Is there any rationale behind it? And we think there is a good rationale that why it has opened up so much. Now that doesn't mean that we will not see a correction or anything like that. But the point is that there's a logical explanation that, why it has gone up over time.
And is this also a reflection of the fact that the market has been more willing to award higher multiples to these capital light businesses than in the past?
Absolutely, yes. That is to some extent true. So the entire market has related, that is true. But that magnitude is much smaller. The mix is probably, is a little bit more, I would say, that explains a little bit more compared to the same businesses getting a higher multiple over time. In fact, if you look at the portfolio that we run, we try to do the same thing. Like we want to see that, if this same company, the same set of companies that I'm buying in now, had the same companies in the same weight allocation, what would be the PE or the EV EBITDA of the portfolio, right? So if you look at 5 year back, the same portfolio would have been trading at 1.5 times the multiple of the S&P 500 multiple. But the same portfolio now actually costs us much lower, much less, right? So the point is that again, there are some companies that have taken the larger share of this multiple expansion, but I would say largely if you're selective, if we just try to look under the radar, in terms of relative valuation, we do find good value, and that's what I've tried to do in the portfolio. We have tried to avoid the most crowded part of the market, which we feel are probably getting into a zone of high multiple, high valuation, which becomes some considering regarding the risk.
And through this, through managing these portfolio valuations, bringing them down relative to the market, how has the portfolio performed?
Yeah, so that's a great point. Yeah, that's where we can conclude. So if you look at that, this in last month or so, we have lagged the market a bit, around 180 basis point, because the market went up just straight one way. So that has been a drag in our performance. But as I said, we try to be conscious about the valuation we are willing to pay for any company. So that pays up at times, like when the trade war, those headlines came in, the market fell around, I think, 20%, 18, 20%. We are down around 10. So that is when it shows up. The point is that through a business cycle, you will have these times of over exuberance and over cautious. But throughout a period of time, the discipline around valuation and growth, that typically adds value, and that's what has been showing up so far in the live portfolio that we have been running for last close to 3 years now. So with that, I mean, I'll stop here. Hardik, happy to take questions.
Sure. Thank you, Arindam. Thank you, JB. Thank you, Prashant, for this interesting insights. For participants, I would just like to clarify, this is a global equities portfolio. The underlying equities are based out of US and developed market Europe. This is not a China fund by any means. However, the discussion was with regards to how, by investing in stocks and in equities in US and Europe, how do you also participate in the growth story of emerging markets? With that, Arindam, there is a question on, while developing economies, as you showed in the slide where there are ranks, they might not be doing that great as a whole. But does that mean that we miss out on some opportunities in these markets, or in China for that matter, where there are stocks which are listed there but are also sort of dependent on their own growth story?
Yeah, no, Hardik, I mean, that's a great question. And I would say that, of course, I mean, in every market, you find these stories which are exceptional.
Sure.
But typically, what we have seen is that if you are investing in certain companies, certain markets, the attention is typically in the top 1, 2, 3 companies, especially in the emerging market side. So if you really want to dig deep into any market, so you need to understand the market well. Especially, you should be very confident about the policies, the kind of system that has been set up that is conducive to capital market return. And that is where I think one need to be cautious. But having said that, I mean, every market will have some exceptional stories, and China also have few. Definitely, I have covered China for a brief time. So yeah, there are quite a few great companies that do exist.
One last question on China, because we're talking about it, is are the earnings really growing? That's one of the questions in the Q&A box, or it's just a P expansion that is sort of playing out at this point?
At this point, it's P expansion. The expectation is that the earnings will be normalizing at some point of time, maybe next year. So that's what you saw, the rally that happened in last year. Is that typically in any stock market, there are 2 phases in the up cycle. One is the anticipation of recovery. That is when your P expand. Then the earnings start to catch up. If the earnings don't catch up, then you probably just stay with the P expansion and it stops there. So as of now, we have not seen too much of earnings revision in the Chinese market. The P expansion part has probably played out.
Okay. Participants, if there are questions, please feel free to write them in the Q&A box, and we'll take them up and ask Arindam and team here. Arindam, in the meantime, shifting gears from China to the developed market equities, There is a lot of discussion around how European markets have done. The stock markets have done really well in the recent times. What's your thought? Are you increasing allocation to Europe, or you see that the strategy remaining as is from
Look,
an allocation point of view?
yeah, I mean, we are not top-down allocators. We do have a fair bit of idea. I think the top-down part, like if you, as I said, like the high-quality companies in Europe, uh, they right now they're getting a very similar multiple to what you get similar kind of companies in the US. But there is an opportunity in late 2024 when the valuation gap actually opened up, right? So again, we are not top-down investor. We are not taking a market call that this market is cheap, so move money from here to there. It is more bottom-up. So in bottom-up standpoint, for example, we added to LVMH, right? We feel the stock has become too cheap to ignore, despite we acknowledge all the things that Prashant told us, that why Hermes is a much, probably a very, very high quality company, especially when you compare against any other luxury brands. But still, we feel that LVMH became so cheap, we thought about buying it. So it is more bottom-up decision rather than top-down. And that's how we typically operate. It can be anywhere. We're looking for opportunities. Wherever it comes through, we'll take it.
Yeah, thank you for that. So on that note, what will be the geographical diversification of this portfolio as we speak today? Would you be able to spell it out for the audience?
75% in the US, 10% in Canada, actually more than 11% in Canada, and the balance would be around say 12-13% in Europe.
Okay, very interesting. There's a question in the Q&A box which speaks about the difference between S&P index and GCP's growth is not that significant, is what is mentioned. However, GCP company contains companies outside of S&P 500 as well. So how do we compare that growth? Would you be able to clarify on that? Essentially, are we hugging the benchmark of S&P 500, or given that we are actively managing the strategy, how do we deviate from that?
Yeah, so just to give you some numbers here, we are not at all hugging the S&P index. It's a 32 stock portfolio actually. So first of all, the geographical diversification, that 25% that is outside of US. There's a number first thing. And the second thing is, if you look at S&P 500, the index composition, one way to look at it is the, say, the largest heavyweights. If you look at the return composition, for example, the 25% CAGR that the GCP has posted, out of that, I think around 20% of that return has actually come from the Max 7 or the top 10 companies in the benchmark, which is S&P 500. Vis-a-vis, if you look at S&P 500's that 20% return that you can see here, out of that, almost 11% of the return has actually come from the top 10 companies, right? So again, 50% of the return has come from top 10 in S&P 500 in last since we have launched it. For us, the number is around 10-15%. So I mean, it is an actively managed portfolio. There are no intention of hugging the index at any point of time. We are aware of the index, but at the same time, we try to make sure that we are able to do better than the index. What we can tell you is that the chart that we saw here, I'll just go back to the valuation. The valuation of this portfolio has actually come down since we have launched by around say 4 or 5% relative basis. Okay, so the point is that our EPS growth of the companies that we have invested in, on an average, their EPS growth is probably has been 3 to 4 points better than the broader market. So despite having a correction in the valuation or the PE or EV/EBITDA multiple, still we have been able to do better than the market. So that is what we are trying to capture. That try to find companies which are growing faster than the broader index, and the multiple is palatable. The valuation is palatable.
Okay. There is a question with regards to any specific sectors or themes that you generally target at. Now, you just mentioned that the portfolio is significantly beyond the Max 7. But given that you spoke about valuations, and given that you spoke about earnings and the MEC 7, where do you see bulk of the exposure from here on in GCP portfolio from a sector perspective?
We are actually sector agnostic, to be very honest. The outcome is that we have around close to 40%. Around 40% is in industrial as a sector. Around 25% is in tech. Balance is kind of spread out across different other sectors. Now, if you think about the S&P's allocation to industrial, right? S&P's allocation to industrial is around 10% or 9% actually, 9 or 10%, somewhere between that. So again, we're very, very heavyweight on industrial, and it is not something that we intended to do, that we want to be overweight in this sector. That's not how we do the portfolio. It's just that we found high conviction opportunities and our comfort zone around companies which turned out to be listed within the industrial sector classification. Right. So when I look at the broader earnings expectation, etc., we are not dividing it by the sectors. We do it in two ways. Number one, we are looking for around 13 to 15% CAGR around the portfolio, like all the companies put together. And we try to make sure that we are not heavyweight in companies where the earnings growth is kind of toppy, or the earnings are supposed to conk off going forward. So these are the two or three basic disciplines that we try to put in place when you think about the future earnings growth. So that helps us to take care of, like in a rolling 3, 4, 5-year basis, we typically get that 15%, 14, 15% of earnings growth. And from here also, I don't think that trajectory is changing. In fact, I'd not be surprised if the earnings growth actually accelerated for the portfolio going forward compared to what we get in 2025.
Okay. So Jabir is here. So there is a question on tech. There is so much happening. The sector is quite hot in terms of the news flow that we keep hearing on these companies, and as well as we do have some exposure in the portfolio. So given what has happened in the last 6-7 months in the United States with regards to Trump and tariffs, what's been your opinion and how are you playing this particular segment?
Right. That's a very broad question, so I'll cover it in 3 parts. Broadly, we divide so US tech into 3 or 4 different buckets. Right, one big part is enterprise tech, which is cloud, which is SaaS. This is a space we're comfortable. We own all 3 of the big cloud players. And the second is ad tech, or advertising tech. Here, and the enterprise side is, it has its own moving parts, its own cycle. It's not that exposed to tariffs. Generally, it's more exposed to how corporate earnings trend over time. If there is a recession which gets caused by tariff policies, then it's a different thing. Otherwise, there's not much worry there. There was an initial stall in deal flow which happened in April, but that has since reversed. People have sort of gotten used to this new reality, and it's business as usual. The second segment is ad tech or advertising tech. Here, we own the 2 big players, which is sort of Meta and Google. This is a segment where we're watching things closely, because there is a portion of business for these companies which is dependent on imports. Right? It's not that they're importing things; it's that their customers are importing things and selling them in the US, and that part of the market is a bit exposed. But these are, at the end of the day, auction-driven platforms, so there is some price damage, but the demand doesn't really go away. It just gets filled by a different customer. But there is potentially some revenue headwind here, but not too bad. The third is semiconductors. This is where, again, because of AI, the investment cycle being what it is, there isn't, in the normal course of things, people would have paused, would have decided to wait in the face of tariffs. That isn't happening because there's a lot of hype around AI. However, here, that hype scares us. And because that hype scares us, we don't own some of the frontline names. We instead own names which are more diversified in terms of demand. So we own TSMC, for example, which is benefiting from the AI demand, but is not just an AI play. And then there's sort of consumer tech, which would be Apple and Amazon's non-AWS business. And Apple, again, has, because of the way cell phones get sold in the US, has a lot more pricing power than people give it credit for, and probably has the best supply chain management skills in the entire electronics world. So we're not so worried on that. And Amazon has been navigating. It's a value platform. When people are worried about money, Amazon sort of a good place to go spend it. Their recent Prime Day sales in the US went off well. So overall, the one thing which we are sort of worried about is the one which is doing really well despite of tariffs. Everything else, things have reacted, and things are sort of normalizing. I hope I covered all of it.
Yes, you did. You did. So back to you, Arindam, on the basis of what Jaybir just mentioned, with specific to tech. When you look at beyond tech as a whole, how has this whole tariffs and uncertainty with regards to what has been happening sort of played out for you? And one of the questions that we keep getting asked is, how do you remain agile and adaptable to these sort of uncertain periods? If you could highlight some points there.
We try to invest in companies. Of course, we never know what is coming, what kind of tariff, etc., would be coming. But in general, the way we try to choose companies which have shown resilience over their history. So there have been different instances, not necessarily tariff related, but there has been other instances where they have shown resilience around those. I'll not say black swan, but challenging times. Let me put it this way. So if you think about when we did the last webinar in terms of tariff market, etc., we showed the typical earnings revision or the downward revision across different time frames, especially during the challenging time. So if we put down COVID, the 2022 drawdown, or what happened in last 2018 tariff 1.0, what happened during those times, and I looked at these companies. Our companies barely shown any downward earnings revision, and compared to S&P 500, it was like S&P was down around, I think, 5-6% in terms of earnings. I'm not talking about the stock market. The earnings were revised down 5-7% average on during those time frame. For our companies, there was barely any downward revision. Now again, we are not preparing for what might come in future, but we're trying to look for companies where the resilience of the business models can actually counter this kind of adverse kind of events that might happen. So again, I would not say that we are kind of too agile around moving things, but what we are trying to be more agile is in the fact that repositioning from one like for example, if a company has outperformed in a short period of time, repositioning some of the allocation from there to something that has underperformed for maybe some temporary reasons that we have used historically, we have done too, but now we are probably going to do it a little bit more proactively. So that is what we might see going forward. So that is probably the one thing that we try to do going forward, more agile.
Sure. And one of the most frequently asked macroeconomic question. Sure. Sorry. I was just saying that one of the most frequently asked macroeconomic question from a global and US perspective is the rising debt concerns, the debt to GDP ratios. Um, uh, from your investment point of view, is that a big concern, and how do you look at it?
I mean, that's a very very broad topic, and as you know, there is not too much of answer I can give there. But our point is very simple. So there, of course, the federal debt is very high at 122% or 123% compared to the GDP. Which is not high if you compare it against some of the other European countries or say Japan. The challenge is that given the fiscal deficit of around 4, 5, 6%, so the debt can keep ballooning, and especially given the kind of expenses on the medical side that US government does. So the chance of getting the fiscal deficit down, that is where the real challenge is. Now, again, we'll see how it plays through. But in my view, there are two counterpoints. One is that if the inflation is under control, then many of these things can be countered. I mean, there's one sort of economic thought that I've been hearing from a lot of people, and I think Cochrane. I mean, there are a few economists talk about it. I've spoken about it before as well. So if the inflation is under control, then eventually these things won't matter to some extent because you don't end up paying too much. The debt burden in terms of interest payment, that doesn't balloon up. The second thing that I think is not often spoken about is the productivity gain. So if you look at the productivity gain of US, that actually outpaces any other country, most of the other countries in the world, right? So with the productivity gain, if they can achieve through all these technologies, etc., then there is a good case of relatively higher GDP growth, and that relatively higher GDP growth can counter the debt burden over some period of time, right? And remember one thing: in the developed market, in the developed countries, US is the only country which is seeing population growth, right? Population growth primarily driven by immigration or migrate, right? So people are coming in, so that gives them around 40 to 50 basis point of demographic growth. So that puts them in a very, I think, I would say, a very good position relative to other developed countries, right, where the population is declining. So they can probably deliver much higher GDP growth compared to many other countries. So again, the debt load is real, but there are some offsetting factors, I think, that also exists. For us, it's very hard to pin it down to a portfolio level. For us, what we try to do is look at two things that are, I think, important for us. Number one, what is the household debt to GDP? Now, the household debt to GDP is around 70% or 68, 69%, which is at the 20-year low. Number two, what is the corporate debt to GDP? So I look at the S&P 500's net debt to GDP, net debt to EBITDA, net debt to EBITDA, and that is also at 2025-year low. Okay. So these are two important things that I look at because the federal debt, what happens, those are probably too hard to gauge. But as long as the other things are not too bad, then there is a high chance that all the problems in the Fed side that is not spiraling up, right, or spiraling down rather to other things. So if that can be controlled, I think again we can probably jello this time and come out of it. Jabir, you want to add anything?
Yeah. Household debt, corporate debt, uh, those are things which matter a lot more for some of the companies we own. That's why we track those closely. On the government side, well, the debt is something we, there's a lot of talk about it and so on. The thing which we actually keep a closer eye on is actual government spending cuts, knock-on effects from that. It if sort of some of the efforts in Doge had kept going and had become much more widespread than it eventually did, that would have worried us a lot more than what's the sticker debt number or what's the sticker deficit number.
Yeah.
It's sort of the predictability of government spend, where it's going, where it's getting cut. That's something we watch a lot more closely.
Okay, great. So those were the questions on the Q&A box. There are a few questions with regards to the structure and the how to invest piece, which I'll try and cover. So this is a strategy which is based out of GIFT City in Gujarat, Gandhinagar. And the minimum ticket size to invest in this strategy is $150,000. There is an accredited investor option also, which is available, which we can further discuss when you'll write to us. And as we mentioned again, this is a strategy which is predominantly investing in developed market equities. We do not have Indian stocks in this portfolio. Neither do we have any emerging market stocks in this portfolio. And by virtue of regulation, we cannot have Indian stocks. And we've been running this strategy from October of 2022, and the latest performance is right there on the screen. Recently, we've also been able to digitize the entire onboarding journey. So for resident Indians, via the route of LRS, which is an official remittance route of RBI, participants, individuals can remit up to $250,000. Out of which 150,000 could be utilized for investing in this scheme. And the entire process is digitalized for our investors for a smooth journey. With that, Arindam, Jaybir, Prashant, thank you so much for taking out time today. And for all our participants who are on the call today, please feel free to write to us at invest@marcellus.in, and we'll be very happy to answer your questions or take any feedback with regards to our global compounder strategy. Thank you. Thank you all.
Yeah. Thank you. Thank you, everyone.
Thank you.
Thank you.